why are the interest rates going down at the same time that the Federal Reserve is raising their rates? So this is a multi-part story. One thing is that the federal interest rates, they have a indirect correlation with the mortgage rates, but the indicator that's a little bit better is the 10-year Treasury yield. Now, this is essentially the government selling their debt, saying they will either pay 2%, 3%, 4% over the next 10 years in interest plus that original amount that you lended them. Now, as we just had an indication saying that we have our second confirmed quarter of essentially negative GDP. So basically, the government has calculated and said that the amount of goods and services that we're producing and the amount of money from that has been negative for the past 2 quarters. And because of that, that's always been a confirmation of going into a recession for the past 50, 60 years, and it's been right every single time. And so because the fixed income investors that are in these mortgage-backed securities and the 10-year Treasury yields and investing in those kind of low interest rate investments, because they know that we're going into a recession, they began kind of running away from the higher risk, higher return investments like normal stocks and bonds. And that's because when the economy is going great, a lot of stocks in the stock market are going to be going up. But when the economy is not going great, you're going to want to go get something that's going to give you a guaranteed return. And that guaranteed return is from the government. Hey, we're going to give you 1%, 2%, 5%, whatever it may be. And typically, the mortgage rates are always 180 points above whatever that 10-year Treasury yield is. Right now, it's at like 2.8 to 3%. So our mortgage interest rates should be around 4.8 to 5%. But because the mortgage market doesn't want to provide, a sticker shock kind of factor to people and scare them off from buying homes, they've already kind of built that in and pushed the interest rates up to 5.5, 6%. So when the Federal Reserve raised their rates 0.75% or 75 basis points, that was already built in. And so we're actually kind of at a plateau, they think, and we should probably come back a little bit and stay around that 5% to 5.5% for the mortgage interest rates, at least for the remainder of the year. Now, if the Federal Reserve sees that this is working, it's combating inflation, inflation is no longer at 9%, it's starting to go down, they're watching this, then everything will be, as far as the interest rates will be good. Okay, they're not going to raise them anymore. They'll probably even actually start to bring them down a little bit to help push more buyers into the market and swing us out of the recession. Because essentially the things that they're looking at, these indicators and the inflation rate and everything, they're lagging indicators. So they're trying to predict and move things around and do monetary engineering a couple of months ahead of time and swing things back and forth. So as inflation comes down and they have the interest rates all the way up here, they're gonna wanna bring this down to level it out and bring inflation back to that 2% marker that they're looking at. So whatever the rate's gotta be at in order for them to hit that 2% mark is what they're trying to do. But I think for at least the remainder of the year, we're probably gonna be at 5.5%. Hopefully that brings inflation down, and if it does start to bring it down to 5, 6% and moving towards that 2% marker, I'm hoping into the next year that the rates will go down to 4.5% at least. And for a healthy market, I think at that point they should actually probably stay there for a couple years, and we should come out of the recession. We should purposely try to come out of the recession and have inflation rise slowly. That way wages and all these other things can kind of catch up, and people can have time to calculate and save and sort of stabilize the market. The problem with all of this is the fact that we have all of these large fluctuations, and a lot of it was caused by COVID and people in the government trying to help but causing more damage, and the market not knowing how to respond to things, and there's just been a lot of confusion. So we just got to slow things down a little bit. But yeah, that's about it. If you guys need any help buying or selling and this is the right time for you for whatever reason, go ahead and reach out to me at 408-275-5601. I'd love to help you out if you're located in the Bay Area. And yeah, I'll see you guys next time.